Investing is the key to wealth creation. But here's the real question. Should you build your investment portfolio with stock SIPs or stick with mutual fund SIPs? Which one truly helps you grow your wealth while managing risk effectively? And most importantly, which one suits your financial goals? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So, with the Indian stock market booming and retail investors participating like never before, SIPs have emerged as a powerful tool for long-term wealth creation. But not all SIPs are the same. Today, we are diving deep into the key differences, benefits, and risk of stock SIPs versus mutual fund SIPs, so you can make the right investment decision. Stick around till the end because I will also break down the tax implications that most investors overlook. So first of all, let's start with stock SIPs. What is a stock SIP? This is where you invest a fixed amount at regular interval in a specific stock, just like how you would with mutual funds. But instead, you are buying shares of a single company. So how does it work? If you believe in the long-term growth of a company like say TCS or HDFC Bank, you can invest in it consistently instead of making a lump sum purchase. Sounds great, right? But here's the catch. You need to choose the right stock. Unlike mutual funds, where professional fund managers do the heavy lifting for you, in stock SIPs, you are the one making the decision. Can you analyze company fundamentals? Do you have the patience to handle market fluctuations? If not, stock SIPs can be risky. So what are the key benefits of stock SIPs? Because if you have expertise, stock SIPs can offer some unique advantage. So number one, direct ownership. You own the stock, meaning you benefit from dividends and capital appreciation. Number two, flexibility. You choose which stocks to invest in and adjust your portfolio anytime. Number three, high growth potential. If you pick the right stocks, you can outperform mutual fund in the long run. But let's be honest, do most investors have the time and skill to actively manage their stock SIPs? That's where the mutual fund SIP comes in. But first, before you jump into stock SIP or whether analyzing which mutual fund SIP will be better, let us first take a look at some key considerations before choosing stock SIP. Because before you jump into a stock SIP, there are a few critical factors you need to consider. Unlike mutual fund SIP, where fund managers take care of stock selection and risk management, stock SIP require active involvement. So ask yourself these key questions. Number one, stock selection. Are you confident in choosing the right stock? A well-performing company today may not necessarily be a winner in the next decade. You need to analyze financial statements, industry trends, and business growth potential. Do you have the expertise to do that? Number two, market volatility. Can you handle short-term fluctuations? Stock prices can be highly volatile, and unlike mutual funds where diversification cushions the impact, individual stocks may experience sharp swings. If a stock crashes, are you prepared to stay invested or cut your losses? Number three, diversification. How will you manage risk? A stock SIP is usually focused on a single stock at a time, meaning there's no automatic diversification like in a mutual fund SIP. To spread risk, you would need to manually invest in multiple stocks, which requires more capital and research. Number four, time commitment. Do you have the time to track and manage your investment? Unlike mutual fund SIP, where fund managers handle everything for you. Stock SIP require you to monitor the company's performance, economic conditions, and market trends regularly. Number 5. Long-term growth potential. Are you confident that your chosen stock will outperform the market over time? Some investors achieve exceptional returns through stock SIPs, but this requires picking fundamentally strong stocks and holding them through market cycles. Stock SIPs can be a great option if you are an experienced investor with the ability to research, analyze, and manage risk effectively. But if we are looking for a simpler, stress-free way to invest, mutual funds offer a professionally managed and diversified approach. Which one aligns better with your financial goals? Why is mutual fund SIP a smarter choice for most investors? A mutual fund SIP allows you to invest a fixed amount regularly in a well-diversified portfolio of stocks, bonds, or other assets managed by professional fund managers. And the best part, you don't need to worry about picking individual stocks. Here's why most investors prefer mutual fund SIPs over stock SIPs. Number 1. Diversification. Your risk is spread across multiple stocks and sectors. Number 2. Professional management. Expert fund managers handle stock selection and strategy. Number 3. Rupee cost averaging. You automatically buy more units when prices are low and fewer units when prices are high, reducing the impact of market volatility. Number 4. Tax benefits. If you invest in ELSS funds, you get tax deductions under Section 80C. Oh, if you don't have the time to actively manage investment, wouldn't it make sense to let professionals do it for you? So now that we have covered the basics, let's do a quick comparison between a stock SIP versus a mutual fund SIP. Here, a tabular column has been presented on the screen for you, and the comparison has been made in terms of investment type, risk level, management, flexibility, diversification, and tax benefits. You can simply pause the screen and take a look at it in detail. So now before you decide, let's talk about taxation, because your returns are only as good as what you get after tax. For stock SIPs, short-term capital gains. So if you sell within a year, you pay 20% tax on profits. And long-term capital gains is if you hold for more than a year and profits exceed 1.25 lakh, you pay 12.5% tax. And there is something called securities transaction tax as well, which is applied on every stock transaction. And for mutual fund SIPs, for equity mutual funds, especially like ELSS, large cap, etc., the short term capital gains is 20% tax on gains if redeemed within a year, and long term capital gains is 12.5% tax if gains exceed 1 lakh. And in debt mutual funds, no LTCG benefits after April 1, 2023 taxed as per your income slab. So which option is more tax efficient for you? It depends on your investment horizon and financial goals. Both stock SIPs and mutual fund SIPs have their place, but let's be real, which one would you choose? If you are an expert investor who can research stocks and manage risk, stock SIPs might be for you. But if you prefer a hands-off, diversified and professionally managed approach, mutual fund SIPs are the way to go. At the end of the day, the right choice depends on your risk appetite, knowledge and investment goals. So which one are you choosing? Drop your thoughts in the comments. If you found this video insightful, don't forget to like, share and subscribe to stay updated on smart investment strategies. Do you need personalized investment guidance? Then click the link in the description to book a free consultation with our certified financial planner and get expert advice on creating a winning portfolio. Let's build wealth the smart way, one SIP at a time. See you in the next video. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.